Alright, today we're going to be looking at Confluent Inc, ticker symbol CFLT. As always, quick company description. So it's a data streaming platform that helps businesses move and process data in real time. So essentially what that means is instead of storing data and then looking at it later and I guess pulling from that data at a later date, the Confluent platform, which is built on Apache Kafka, a technology the founder created, lets companies instantly stream information like payments, orders and sensor readings. This then allows for real-time analytics, fraud detection, and most importantly for this trade thesis, to power AI pipelines, which need continuous real-time data streams to help improve decision making. So as you can see, the trade thesis here, we won't go into it too much just because we'll round everything up at the end and summarize everything then, but you can pause the screen and read it here if you want to. As always, we're not going to go through everything in this document, otherwise the video will go on for too long. However, the first link in the description, you can go grab the document for yourself and I guess read through everything in your own time. So I guess what we'll be focusing on first then is the business overview. This is to help you guys, I guess, to get some context and understanding of the business itself. So I guess you can break down Confluent via its two main primary products, which is Confluent Cloud and then Confluent Platform. So the cloud system, as you can see here, is a fully managed cloud solution, whereas the Confluent platform is a kind of self-managed on-premises version for larger entities who I guess want more flexibility. So in terms of revenue then, the company in FY24 generated just under $1 billion in revenue. This was up 24% year over year, with 96% of this revenue coming from subscription revenue, which was again the two main products or platforms. So Confluent Cloud then was up 41% year over year, representing around 55% of total subscription revenue, and then the 45% of the other remaining subscription revenue obviously then came from Confluent Platform, which was up 13% year over year, so slightly lower. So you can kind of see the SMEs and kind of smaller entities which require more help, and a fully managed service is currently, I guess, more popular and more in demand at the moment, which I guess makes sense because larger companies are more likely to have their own tech stack and kind of do it completely themselves without requiring a company like Confluent to help them with this service. In terms of profitability and cost drivers then, Confluent enjoyed around 80% gross profit margins, which is really strong, but also kind of expected for a software as a service business like this. However, it is worth noting they still to this day are making a GAAP net loss due to primarily heavy investment, which again leads me on to the next point, the main cost drivers being R&D and sales and marketing. So R&D always comes in 100+ million per quarter. This is obviously then to fund the technology that is on pretty much on the cutting edge. So the streaming processes like Flink, governance connectors, all those kind of things. And they also do spend very heavily on sales and marketing. Again, as a growing business, they need to kind of get into as many hands as possible. They need to be seen by as many eyes as possible. So this again makes sense. Although it is worth noting that the sales and marketing, I guess, increasing expenditure is, I guess, growing at a slower pace. So it's still growing, but at a slower pace, which is, I guess, starting to indicate some efficiency improvements. And then also on profitability, it's also worth noting the company finally turned a positive cash flow from operations in FY24 of 34 million. So of course, to understand the business, you also then need to understand the sector and the market it operates in. Obviously, that being the real-time event streaming. And I kind of already mentioned, but yeah, the use cases are AI, personalization, Internet of Things, live analytics. And so in 2022, the target addressable market, TAM, was around $60 billion. This has then been growing around 20% annually to 100 billion this year, so a relatively decent market size now. And then this is also then expected to grow to around 150 billion by the end of this decade. And then Confluent themselves only capture 2% of this entire market, so there's plenty of upside to be had here. And then kind of moving on to then the competitive positioning and moat. As I've kind of mentioned already, that Confluent is a market leader with the Kafka solutions and enterprises, given the fact that the CEO is essentially the founder of the Kafka technology and kind of basically created it. So they have this tech leadership, I guess, moat already and competitive positioning versus competitors. They're also cloud neutral, so unlike your Amazons and Microsoft, who also, to be fair, do offer this solution and they also bundle it with their cloud services, it is worth noting if you're an enterprise who prefer to be on multi-cloud, services, or then this is really attractive, proposition for you. In terms of the key challenges for the business, I'd say there's 4 primary ones. That's again the open source competition. Kafka is free, as I've mentioned, and so you do need to provide users with an ROI. Cloud native rivals, again, I've mentioned. So you've got Amazon, Microsoft, who essentially bundle their services with their cloud services and kind of offer this solution as well. But then it kind of restricts you and confines you to that platform. So there's a downside to that. There are also emerging alternatives. So you got Red Panda and Pulsar. And then, as you'd expect with a growing tech company, there's profitability pressures, right? So they're still unprofitable on a GAAP basis, and they essentially need to scale, but at the same time try reach profitability. So it's kind of like 2 levers that you're kind of, managing at the same time. This is the case with most tech growth companies, as you'd expect, but it is a key challenge to obviously be aware of. And then the bottom line, we won't go too much into because, again, we round everything up and conclude at the end. So as always, we also then have an abridged financial statement looking at the key line items in each statement, being the income statement, balance sheet, and the cash flow. I don't want to go too much into this because, again, I'm trying to avoid these videos going on for too long and basically boring you guys. So what I'd like to obviously draw your attention to is the cash flow from operations now turning positive, which is great, and then the free cash flow being positive based on the operations. Obviously 2021 it was, but that was because of financing, so it's basically cheating. And then we also have some graphs here. Again, you can pause the screen and kind of look at it. It's nicely presented as always for you guys to have a quick overview of that. An important thing to always look at then is the sector comp and the competitors. Specifically, what I like to look at here is this analysis bit here, which I've nicely color coded for you guys. So again, from a bird's eye view, you can quickly see if it's good or bad. But again, I like to look at the top line, which is revenue, and then the bottom line, which is earnings, and then also I'm ensuring that it's forward looking, because again, in investing and trading, we want to be forward looking as that's what moves the stock price. So in terms of Confluent then, it's, as you can see, quite clearly a positive sector outlier in that then the valuation multiples are below the sector average. So again, forward EV to sales of 4 and a forward PE of around 44 versus 9 and 75 or 17 and 86. You want to add the megacorps in. And then they also then have revenue and earnings growth, so being above the sector average. So the valuation multiple is below the sector average, so quote unquote cheap, but then the performance is above the sector average, which again you very rarely see. What you'd normally see is something like, say, Snowflake, which they have above average valuation multiples, but it's justified because they have extremely good forecasted growth. And so this is a typical setup you'd see, and it's not something that would stop you from buying a company. In fact, it would make you quite bullish because then it indicates the market agrees with these figures here and it's valuing the company accordingly. Whereas when you see a scenario like this for Confluent, so 4 greens all in one go, it kind of indicates either a trade opportunity or something to be wary of, where the market maybe knows better and it knows that it's not going to perform to these numbers, or there's a dislocation between performance and price. As you can see, the key thing that stands out here for Confluent, however, is the net profit margin. It's significantly loss-making, in line with, again, Snowflake, which you'd expect. They're completely focusing on top-line revenue growth rather than profit maximizing. So again, this is kind of to be expected, but there is obviously the downside risk of, well, if they're making a 32% net loss margin, that's a long way to go to claw back to even 0% and break even, right? So that is, again, something to be wary of and to consider. We're going to skip past the fair value and price target because that'll be the end, and we'll discuss that then. So moving on to the qualitative factors then. Usually I like to gloss over this, but I highly recommend either pausing the screen and reading this, because especially the weaknesses and threats, they are quite significant, and if you were to buy the stock and go long, it's definitely something to be wary of. As you'll see when I do a technical analysis, the stock price has crashed, and I think for very good reason, but then it also kind of provide some opportunity. The Wall Street Insights kind of in line with the SWOT analysis, to be fair, but again, you can kind of read the bull case if you were to go long, or the bear case if you were to go short. Although again, if you were to go short at this point, I'd argue kind of pointless, given the stock price has crashed more than 30% in the past month. So we also always do a management analysis. This is normally my favorite, or my most, important qualitative factor to look at is the management themselves. Although I do kind of want to gloss over it in this scenario, just because basically the management hasn't been great, and that's the reason why their stock has created. They're just not executing properly, and they're not taking advantage, especially the last 2 years, of their technological competitive positioning. They're not taking advantage of that, and now the market's kind of catching up and maybe potentially kind of saying, actually, a big segment of your business is maybe obsolescent. You can kind of pause the screen and read it yourselves, but I'm not too bullish on Sean Clowes, who basically is the new CTO. And yeah, again, the management has kind of messed up. So I guess that's all the negatives out of the way. But looking at the positives, then a big positive is the momentum and technical indicators. This isn't something I normally, I guess, focus too much on or care too much about. But when it's as obvious and like in your face as this, you have to, I guess, take notice. As you can kind of see here with a very simple technical analysis here, I like to basically not get too complicated with technical analysis and primarily focus on support and resistance levels. Over the last, I think it's like 2.5 years, you have a very clear support level of around $17. As you can see, it bounced off here, continuously pretty much bouncing off around here. And then it has a very clear resistance level of around $38, $40, wherever you want to round it to. And so with the stock price currently at 17, it indicates, at least from a technical analysis perspective, a very good potential buying opportunity to even just trade it and potentially flip back into maybe the mid-20s, which then also leads us on to the fair value price target analysis, which I guess spoilers, but my reasonable price target is around $24, representing upside potential around 40%. So that, in conjunction with the technical analysis, for me personally, indicates a really good trade opportunity here. In terms of long-term investment opportunity, I'm not too sure. Again, I think in that case, you'd have to be very bullish on this technology and the future use case. I personally am very bullish on the technology. I think it's a great, very relevant, especially with AI and the current LLMs and everything kind of going crazy the last couple of years. I'm very bullish on the technology itself. Whether or not management can execute and make that into a profitable business that's continually growing is another question. However, even if they can just have the, I guess, perception that they can turn things around, their stock price is going straight to 30. So I think from a risk rewards perspective, this is a really good, I guess, trade opportunity in my opinion. That being said, I do think the current stock price of $17 is justified. So I wouldn't buy this as a valuation play, even though, again, I've kind of shown a valuation that's 40% higher. I wouldn't really buy this as a valuation play because, again, management has dropped the ball. There is concerns around the commercial viability of the product, especially as people try to optimize their tech and software stacks. And so, like I say, when you look at all this, and again, you can kind of pause the screen and read the, I guess, conclusion for yourself, but 20% growth, improving margins, a strong cloud, software as a service mix, solid KPIs, again, albeit they are not as good as potentially some of the competitors, and they are declining, but they're still very strong, right? Like most businesses, it would absolutely kill to have a net revenue retention of 115%, gross retention of 90%, 24% increase in annual recurring revenue customers who spend more than $1 million. Like, those kind of KPIs most companies will kill for. And so based on those KPIs and everything I've mentioned, I think an 8 EV to revenue multiple is really fair, to be honest, and something that I think even if we had a market dip, I'd still give them an 8x multiple. And with that, you can kind of see a stock price valuation of 26. I then obviously aggregate that then with the AI price target models. So again, if anyone who's not watched my videos, investing.com, their pro subscription has like basically AI models that do the most typical valuation modeling, so like DCFs, other price to book multiples. All that kind of cuts a lot of time and, I guess, fluff from the analysis, where again, you don't really want to be valuing a company like this on its EBITDA yet, but it's also kind of, I guess, nice to know. And so aggregating all of that, you do get an average fair value of around $22 as well. And so, yeah, if I had to value the company, I'd say around $24 a share personally, which as of today represents 40% upside. Yeah, don't think there's much more to say than that, really. Obviously, if you do have any questions or any maybe potential rebuttals to the valuation target, especially here, then leave them down below in the comments. I always like talking to you guys. But yeah, other than that, hope you did enjoy the video, and yeah, until next time.